My name's Kayla Firking. I have a new title, Vice President National Exchange Director. So this is 3 weeks coming. I'm very excited to be running the entire country for our company now. It's been about a decade, a little over a decade that I've been doing this. So today I want to share with you what I like to call frequent 1031 exchange mistakes and pitfalls to avoid. So I'm also licensed in the state of California, working on other states too. I like to always be in the know of contracts, of course, and tax codes, my specialty. And the main takeaway here and the purpose of this class is to, of course, go over the overview of exchanges, the broad scope, talk about equations, understanding the value and understanding replacements, timelines that are critical. From my perspective, what I've experienced, way back when, 15 years ago when I was selling real estate like yourselves, how I could pivot and really get ahead of this and become what I like to call as an exchange agent. So there's 9 different mistakes and pitfalls that we're going to discuss today that we want to avoid. So we're going to cover each one, and after each one we discuss in detail, I'm going to pause. When I pause, please use that chat to your advantage. I'm going to keep my eye on it. So as questions come in at the end of each, pitfall, as I mentioned, we're going to review those questions and I will answer them as they come in. Hopefully they pertain to that pitfall because again, we're going through the 9. So if you do have that handout on hand, please take a look at it because maybe your question's coming, which is awesome. If you do have real life situations, please fire away those too that pertain to those pitfalls. All right. Maybe something you've experienced. All right. Looks like we're set here. So I'm going to get rolling. First and foremost, I am not a tax advisor. I do not give legal tax advice. That is for your CPA. So today we're discussing IRC Section 1031 and the basics around the regulations and provisions of that tax code. A little bit about myself, I kind of emphasize on the time of, my experience in this industry. I've worked for several large title-owned QIs, qualified intermediaries. I have my license, in addition to now running this company for Leader Bank. So Leader Bank is a bank, obviously out of New England. They have a subsidiary classified as Leader 1031. So that is our company that we run, my company that we run as a subsidiary of Leader Bank. So we're bank owned and operated, offering the highest level of security of funds. And remember this because this is going to come up down the line about security of funds and 1031 exchanges. I always like to do this knowledge check. It gets kind of people loosey-goosey and getting people to fire away questions. So does anyone know what IRC stands for? Because I may have said it already. If anyone caught it and you want to plug it in the chat there, I would love participation. It's a very small group today. So you get this one-on-one experience. Well, I should say 10-on-1 experience, if you will, to communicate with me. Rick, thank you. Yes, Internal Revenue Code. Awesome. Thank you for participating. All right, the next question, you may know this, Rick, or if there's any other takers. When was IRC, Internal Revenue Code, Section 1031 added as a tax code? So within our federal government, right, we have the IRS. Does anyone know when 1031 was created? Okay. So this one is 1921. So in 1918, we, as the United States, implemented federal taxes. So after that, a few years following, this had a huge stressor on everyone that owned investments, whether it's, bonds, understanding stocks, back then kind of regulating into that theory, real estate. So how do we maintain our capital gain and not pay taxes on the land that I own when I sell it? So that's why it was 1921. We've been doing this for a long time. So it's a good talking point with your clients. This has been around for a long, long time. Does anyone know when the exchange period ends? There's some timelines that we discuss in 1031 world, and this one's very specific. I'll go ahead and answer this one as I don't see a response yet. Linda, thank you. Yes, 180 days. You nailed it. So the exchange period, right? 180 days. Thanks, Rick. You got it after closing on relinquished property. I love it. So I'm learning now with these responses. Y'all are educated on 1031 provision. So that helps me, breeze over some of the basics, which is fantastic. And for those of you who aren't, super savvy in the exchange space, this is an opportunity to learn and grasp on those strategies, but also fire away in the chat. That's what we're here for. All right, so that was that one. And then what is the maximum amount of capital gains taxes you can defer? Does anyone know if there's a limit on the deferral? So this is my trick question. Ha. I bring this up because there's this common misconception that 1031 exchanges were capped, and in fact, they are not capped. Meaning, if I have gain of 50 grand on a property I bought maybe 2 years ago and I want to exchange it, I can redeploy the entire investment, the basis plus my 50 gain, and exchange it. If I have 20 million in gain over the course of owning a property for 30 years, let's say, and it's a huge commercial building in Los Angeles, right? If I want to do that, I can. There's no limit to how much gain I can defer in paying taxes. So the goal of the 1031 exchange is kicking the can down the road, right, to defer those capital gains taxes and redeploy your entire investment, thereby contributing to compounded real estate wealth building. So that's kind of in a basic nutshell of what we're doing here. Directly from the tax code, it states no gain or loss shall be recognized on the exchange of real property. I'm emphasizing things here because we're about to go in our first pitfall. Held for productive use in a trade business or for investment purposes if such property is exchanged solely for property of like kind. Love that term, which is to be held for either productive use in a trade business or for investment purposes. Sometimes I go around saying that, but let's just do a quick takeaway here. It's the sale of an investment property, followed by the purchase of another investment property, facilitated by the qualified intermediary or the exchange company in the middle, right? So we're not recognizing gain because there's a qualified intermediary involved. That's me. So my job is to hold cash for a living in between the sale of that one investment property and maybe one or more replacement properties. So you're redeploying that entire investment to fulfill an exchange of properties. So I talked about this earlier about the 1918 and 21. So why we're implementing that federal tax, taxation that occurred in 1918, and then why we introduced 1031 in 2021. Just a light touch here that the tax number and code has changed a couple times. The main takeaway here is remember when you're talking to your clients and if they get nervous about exchanges, this has been around for quite a long time, and we've done probably millions of exchanges at this point in our country. So when we looked at the changes of the different regs and understanding the implement of what the 1031 did and how many different changes we've seen, we really looked at that introduction of an exchange. And then every decade or so, we would see these changes of restricting timelines, understanding what you could exchange like for like. And that really catapulted us into the 70s, late 60s to 70s of the Starker case. The Starker case was intended by this gentleman and his son and daughter-in-law, where they sold real estate with lumber. They wanted to buy something with those sale proceeds, and Mr. TJ Starker said, well, I'm going to wait 5 years and have the buyer of the property he's selling not actually gift him cash, but the buyer of the property, even though they were in contract and he became on title after the close, there was no cash actually trading hands. The cash was then designated within a 5-year timeline. Sounds nice, right? To buy all these replacements for Mr. Starker. So, of course, the IRS challenged it, saying absolutely not. You cannot have that long of a timeline. I mean, you think about the economics and the volatility we've seen in the last 5 years. So even though it would be advantageous, they said absolutely not. So the timeline restrictions we're introducing here that we talked about, the 180 calendar days, that means you have to complete a 1031 exchange from selling a relinquished property and closing being on title to a replacement property within 6 months, 180 days. This restriction and regulation was part of the Tax Reform Act in 1984, implying, right, this is now restricted to that timeline, in addition to a 45-day identification period, which we're going to dive into. On top of that, a takeaway here is understanding that interest in a partnership cannot be exchanged. So when you're doing your job and you're at a listing appointment, you're signing all these contracts with your client understanding who the actual seller is. If there's ever an LLC on title, it's always good to understand, is the entire LLC doing an exchange? Are there multiple members and it's classified as a regarded LLC? Maybe one of them doesn't want to exchange. This brings up this point that the entire LLC should be doing the 1031 exchange for a full tax deferral. We have a few different avenues we can take that are advantageous here, but we'll deep dive into entities in a moment. So I think we've covered here, that when you sell real estate, you list your property, your client's property for sale, and they collect cash. It's traditional, right? They're paying taxes, of course. So in a 1031, your client, the seller, is not receiving any cash at all. It's going to the qualified intermediary, the segregated account, thereby deferring the capital gains taxes. In my humble opinion, this is the last and greatest tax code available to real estate investors. It has been up on the chopping block from time to time in discussion, depending on who's in the office, understanding, do we want to have this be advantageous for investors? Are we cutting it back? It has never been cut. So we're still here going strong from 1921, and it is the most advantageous to everyone on this Zoom right now. We eliminated the opportunity to do personal property exchanges and real property exchanges in 2018. So where before you could have 1031 exchanged, let's call it an investment condo, into a boat. Boat moves, that's personal property. You could exchange diamonds and gold, things we can touch, tangible, for stocks, bonds. That is no longer applicable. It's only applicable to real property, real estate, and that's your profession. So your clients who are interested in exchanging may be looking to diversify, they're maxed out on depreciation. I mentioned that LLC issue. Maybe they don't want to be co-owners anymore. They're tired of being a landlord. The big ticket one is relocating to another geographic area. They want investment properties with them. And then, of course, leveraging those properties to improve cash flow. Maybe I sell for $1 million and I buy two at 500 each, or I buy two at 750 each. Then I'm adding debt to my purchase or more cash, right? So I'm leveraging those properties to move them around and get some more cash in my pocket. All right. That was the first 10 minutes of the quick crash course version. So we're going to do that deep dive right now into pitfall number 1. Never, ever, ever close on the sale of the relinquished property without setting up a 1031 exchange first. I have had experiences where I've had financial advisors call me on a Monday and declare, hey, Kayla, my client closed on a Friday. They're ready to do the exchange. This component of my job that just stresses me out the most is the lack of preparation for even someone in the financial advising world. Getting ahead of it. As soon as your client's property is in escrow, contact your qualified intermediary. We'll have a consult discussion. We'll decide if this makes sense, if there's enough gain to do the 1031 exchange, and prepare it. So in preparation for the 1031 exchange, we need multiple documents. Okay, so we're gonna need a notice of assignment. We're gonna need a cooperation clause that comes with that notice of assignment. Maybe you guys have seen this in the MLS, so preparing ahead of time. The buyer is aware that the seller intends to perform an IRC Section 1031 exchange at no cost to the buyer. That's usually the basic one. Our assignment has this in place. Guess what? The buyer has to sign the notice of assignment. So they're going to get this document at some point. Being transparent up front is a benefit, right? I've had one situation in the last decade of my career, and it was a huge property sale, and it was in Lake Tahoe and the Keys, and they were so excited to sell $3.4 million. And the buyer at the closing said, hey, I don't even know what an exchange is. I don't want to do this. I feel uncomfortable. And they backed out of the transaction. So the realtor and I had a great chat about that, and it was just really, really awful. They had to go back on the market. They found a new buyer eventually, but if this would have been declared in the MLS, if they didn't get our notice of assignment at the end, maybe it would have been, smooth sailing ahead. That switched really quick. Not sure if you saw it on your screen. I'll go back. So this is for the relinquished, and then here's a cooperation clause for the replacement. So feel free to take a picture of this, use this if you want. just indicating now that the seller, because now your exchanger was the seller, becoming the buyer, and you're notifying the seller. The seller is now aware that the buyer intends to perform 1031 exchange, right, at no cost to the seller. All right, Rick, I see a question from Rick here. I'm going to answer it since we're on this topic. Is it okay not to disclose that you're doing an exchange while in talks with the replacement property listing agent so as to not grant them leverage over you? Absolutely. Yeah. I mean, hold the cards close to your vest, right? Keep your cards close. This is sales, as we know. So great question. When you're in contract, of course, we're going to be working with title and escrow, and there is also going to be that notice of assignment. To get in the weeds, it is not a legal requirement to have that NOA signed, notice of assignment, on either end. It would be preferential for every CPA I've worked with when filing their clients' taxes. So just keep that in mind. You don't need to reveal it up front, Rick, but it would be advantageous when you're going through the transaction, right? And you're also in escrow. So when we look here at the timeline of an exchange, right? The exchanger lists their relinquished property for sale with you. You open escrow, the sale proceeds are wired into that segregated escrow account. Then they're transferred over at close of escrow to the qualified intermediary segregated bank account. Okay, so we hold those funds within the regulations and restrictions of the timeline. You find them that replacement property, make an offer. If they need an EMD, we transfer that over. And then final disbursements go over and we direct deed title back to the exchanger taxpayer. So the visualization here and the takeaway is the only difference we're seeing from the 1031 to a traditional sale is the qualified intermediary in the middle, holding the cash under what we call safe harbor regulations. So we emphasize the 180 day, but let's talk about what begins. This is the stressful part, what everyone likes to call it, of the 1031 exchange. So when the relinquished property closes, the exchanger has 45 calendar days, including all holidays, weekends, to formally identify in writing to the exchange accommodator, us, the qualified intermediary, same thing, by the 45th day at midnight. Now, during this timeline, I recommend making as many offers as you want. In the eyes of the IRS, an offer is a handshake, okay? So you're shaking hands, deciding if you want to do an inspection, get in, how's the property? There may be multiple offers, right? The identification is that final statement and declaration of intent by the exchanger saying, hey, I'm absolutely going to buy this property. If there are 3 properties identified using the 3 property rule, which we'll cover in a moment, then they have to choose maybe 1, 2, 3, as much as they have in their exchange account. If they identify up to 3, they need to either A, spend all the cash, so that could just be on one property, or B, acquire all properties ID. So again, if there's leftover cash, it should be designated towards one of the properties. So keep in mind when you're doing the identification, sometimes it's advantageous to write down more properties, right, on our identification form. But the cons of it are you're now restricted if there's extra cash to remain in that account. And we're gonna peel back a couple layers there on that in a moment. So how are we figuring out an ID? Right now, our new format is our clients are sending us, or the realtor is sending us with approval of the client, the replacement property address. They can send it by email so that we save that email. We'll plug it into our identification form that then goes out to the exchanger taxpayer and they sign away digitally, right? Keeps everything very, very clean and concise. I will tell you last Friday was a bank holiday for, everything was closed and I had an exchanger taxpayer send me in on her 45th day at 11:56 p.m. Kid you not. And I was waiting for it. It was fine. Her ID. So I plugged it back in. She worked with her realtor. And in some cases that happens, but we're here to support you. So use the timeline if you need it, right? We had the signature and we're good to go. Now, I mentioned the 45-day rule. I like to break it down and say it this way. It might help you in your pitch too. So you close on the relinquished property, then you have 45 calendar days to identify the replacement property or properties, plus an additional 135 calendar days to close, totaling 180. So I always like to include that 45 because I think sometimes people assume, oh, I have 45, and then if I have a long close, say a new build property, it's going to take longer. I get this additional cushion. And that's simply not the case. The 45 is inclusive of the 180. All right. So not understanding the requirements for full tax deferral. So what do I need to buy? I hope everyone here has seen an ALTA, right? A little ALTA settlement statement. So American Land and Title creating a settlement statement, and this is done by title and escrow. When we're looking at that form, right, it'll show your commissions. It'll show any payoffs to the bank. It'll show evaluation of credits and debits. All the way down to the very bottom, it'll say due to seller, right? That is the number that we typically use in evaluation for full tax deferral. We call that number the net equity, right? So the net is the cash that's going towards the 1031 exchange. If there's a loan payoff, maybe up here somewhere, paying US Bank, what have you, whoever the lender is, that amount is also applied. So how do we figure out the value of real estate, right? We have to reinvest all the net exchange proceeds and acquire a property with the same or greater debt. So a little takeaway jingle here, the net plus debt. That is my value for full tax deferral. Well, there's no debt on that property. Amazing. It's just the sales price, right? Minus closing costs, or another word is your net. So it's pretty simple looking at the valuation when your clients ask you, well, hey, what do I need to buy for full tax deferral? If I sell this and I do the exchange, I really want to know what my buying power is. And of course, this is the United States. You can go big, right? You can add cash to the equation. So a visual here, let's talk about an example scenario. Mr. Smith decided to sell his property and list with Rick. Rick listed his property for $900,000. Mr. Smith had a loan payoff of the amount $300,000. So he owed the bank 300 grand, right? And then the cost of sale, we'll call that closing costs, commissions, title transfer, recording, escrow, all of that. So what remained is a net equity number of 540. So Rick sits with Mr. Smith and says, hey, I want to remind you that we have to, one, reinvest all net exchange proceeds and acquire property with the same or greater debt. All right. Absolutely, Mr. Smith says, and Rick goes to work to find him replacement property. And he finds him this dream property for $1.2 million. So let's revisit 1 and 2. He needs to reinvest the net exchange equity or proceeds and acquire property with the same or greater debt. So Rick tells us, hey, Kayla, here's a new contract. We're going to need you to transfer over all the net equity in the amount of 540. And Mr. Smith meets with his preferred attorney, hopefully provided by Rick, right, and his connections and referral base. And he says, hey, Mr. Smith is going to need a greater loan to buy this $1.2 million property, but he has a down payment of 540 cash coming from the accommodator. So they get him a new loan in the amount of 660, thereby getting to that purchase price of $1.2 million. I'm introducing a term here, boot. There is no boot in this exchange. And what boot is anything that is non-like-kind property. I usually wear boots when I'm doing this in person to show, my cowboy boots. Hey, so this is tangible. This is something that I bought and I paid taxes on these boots, right? So when we're looking at that, that's your takeaway. Boot is anything that I can touch my cash. The other viewpoint is it can also be part of the mortgage that's not replaced. And I know some of you are probably saying, what? What does that mean? So I'm going to change screens here real quick. So it switched to a different property. Let's say in this same scenario of the sale, Rick takes Mr. Smith to a property that he loves, but it's only 700 grand. So for full tax deferral, Mr. Smith realistically needs to buy something for 840 grand. How I got there is my 900,000 minus my closing costs, right? That gave me 900 minus 60, that's 840. How I mentioned before, flipping the equation, what's my net plus my debt? My cash that's in the exchange account is 540. The loan I have to replace is 300. That's the real value of the property that's being sold, right? Because even in the listing price, we know it's a little inflated to cover the closing costs of our expenses as real estate professionals. No one works for free, right? So, so we're looking at this scenario. Mr. Smith went forward with this property and he got a loan reduction on his replacement with his lender for 260. So now he has mortgage boot in the amount of 40,000 because it went down from 300 to 260. Okay. So that means he's going to owe capital gains taxes applied to that 40,000. But hey, wait, he only indicated to Leader 1031 is QI. Only wire over the 440 cash, Kayla. So we transferred 440 and there's left over 100 grand in that exchange account. So the combination of Mr. Smith's taxable boot is now 140. Even though the 40K doesn't exist, it still tracks on your taxes for what you sold and the value and what you need to replace, which was the 840. So my 840 plus my replacement purchase price of 700 is $140,000 in combined cash and mortgage boot. Okay. So looking at the valuation here, a lot of our clients are comfortable with doing a partial exchange. So in a partial exchange, this is what we call this scenario. There's cash left over or they're going down in value. It is not all or nothing, friends. You can do a partial exchange and it is very desirable right now. So if someone wants to buy something for a little bit less, defer a portion of the gain and pocket some cash, pay a little bit on in your taxes on that, right? Every 100 grand out of California on average is about 38 to 42% in capital gains taxes. I know it's high. I think some cases I've seen at 35%, but that's kind of my ballpark that I give on an estimation. Again, not a tax advisor. We let them navigate that with their specific tax bracket on the federal level, what they've depreciated, and all that good stuff as far as any other losses they may be able to take. I'm going to pause here. Any questions on that equation before I move forward into pitfall 3? Okay, I don't see anyone in the chat, but if you plug it in, take your time. I will address it as soon as I see it pop up. So pitfall number 3, in coordination with your handout in front of you, is selling or exchanging into a property that is not held for investment. This is 101, friends. I can't tell you how many times I get calls of someone saying, hey, I have an exchanger for you. You know, my real estate affiliates, or even just an investor calling me, an investor saying, I'm selling my property. I'm so excited. We want you to be our accommodator. Okay, have you lived in the property within the last, 2 years? And they say, yeah, it's my primary. You cannot exchange a principal residence. So takeaway again, you cannot exchange into a principal residence. And I'm going to pause here. Thank you for your question, Linda. Oh, perfect. This is about the identification and our previous, formula with the ID timeline and then the formula. So she said, what happens if we cannot sell, got it. If we cannot sell our property in 45 days, can we get an extension? No extension. So if for some reason we don't receive an identification form, worst case scenario, the cash we're holding is wired back to the exchanger on day 46, and they bought an opportunity, right, in an exchange to perform. So it's an opportunity. If you don't find replacement property, it goes back to on day 46. If they did identify and can't close on the property within that additional 135 timeline, the cash we're holding has to remain there by force of the IRS until day 181, or the timeline has expired. So it's either or, right? Your intent still remains the same if you formally ID. If you don't, your intent changes to, I want my money back. So the only time we've ever seen an extension is if there's a disaster, which we don't want anyway, right? We don't want a disaster near our property. It's going to change the entire value assessment. So great question, Linda. Thank you for that. I will say a little tool for your arsenal there is you can be in contract with both the relinquished and the replacement property at the same time, right? So I have a client where we have multiple exchange scenarios. One of them is called a simultaneous exchange, where they both close within 72 hours or 3 days of each other. So we're currently working on one right now, actually 2 or 3 probably with my other sales team, but you've got someone closing a property on Monday, next week, and then the replacement closes on Wednesday. So we can set them up with a letter of direction to do that. And again, you're in escrow with both at the same time. So in theory, the exchange timeline is irrelevant. When you close on your relinquished and your replacement within the 45-day period, that's the purest form of identification. So you've completed it successfully. All right. So switching gears back to this for what is what doesn't qualify, right, in a 1031 exchange. So principal residence, property held for sale. That's a flip, right? A flip property. The intent to hold, and this is another question, how long do I have to hold my property as an investment before exchanging? Typically a year and a day is what our CPAs indicate to us. The more conservative holding timeline is 2 years and then exchanging. So anywhere between that sweet spot of a year and a day, you've cycled through one full tax-paying year, all the way up to 2 years is your minimum threshold right there to exchange. We talked about you can't exchange your interest in that partnership. You cannot exchange a REIT, a real estate investment trust. Even though the trust umbrella owns the real property, those are shares that the investor owns of the REIT. So those shares are not transferable. Again, that's interest. So what does qualify, right? We talked about real property held for a business, right? Productive use, investment purposes. So what can I exchange is called an industrial building. Maybe I own this outright. Maybe I own it as tenants in common and I have an undivided 20% interest in this building. When that property sells, I can exchange my portion and maybe buy into another tenants in common. Maybe an office building from industrial. Maybe I sell my portion of this building and I exchange into land. I have some excess that Mr. Smith with the 700 grand, he had 140 left. If he didn't want to pay a dime in taxes, maybe he finds some land for 140K anywhere in the United States. He can exchange that land for a vacation rental. Maybe he really wants a cabin up in Mammoth or Lake Tahoe, as I mentioned, that he wants to go ski or snowboard and also rent it out as an Airbnb. That qualifies. You can exchange that vacation rental for oil rights, mineral rights, gas royalties, wind turbines classify or drive out to Palm Desert, right? All of those have an assessor's parcel number and they produce income. That's real property held for investment. And then there's also DSTs, Delaware Statutory Trusts, which are both securities and investments, which would fall under the first two buildings. And I'm gonna take a deep dive into those at the end of our session today as alternatives if you do fail in that exchange to Linda's portion, or excuse me, Linda's question asking about the extension. There are backup properties, okay? A duplex, triplex, single family, a condo. You don't have to sell a condo and buy a condo. So the takeaway here is land that listing. Talk to your client, see what they have, your single family or maybe multifamily that you can sell all the way up to 4, right? And have them list it. Maybe they want to buy commercial. Partner with a commercial agent, broker, and decide, hey, they really want to open a coffee shop. That's been their dream, or a yoga studio, or what have you, right? There's so many opportunities here to unlock wealth in those real estate sales and redeploy that investment into our economy. I'm going to pause here at the next pitfall. This is why you should add contingencies in there. So if you cannot complete a 1031 exchange, you can still back out of the current investment property sale. Yep. So that's part of that timeline we talked about, right, Sherry? So to her point, when we're looking at that, when we look at highest and best offers that come in, what is classified as best? A lot of the time financing, a lot of the time it's a quick close of escrow, and obviously highest speaks for itself. But in the 1031 exchange, your best is going to be that timeline that Sherry's referencing, right? And we've been going through and through. So if I get an offer for maybe an all cash 7-day close, even though it sounds enticing, as a real estate professional, I wouldn't be doing my support job as a fiduciary to support my client if I didn't tell them, hey, a response or a counter, let's do a 30-day close with the option to shorten that close on the selling side, or to Sherry's point, maybe a contingent buyer offer. So that brings me all the way back to Rick's first question, right? Sometimes you don't need to disclose it, but in some cases you do, right? Especially if you're getting ahead of it. It is advantageous for both parties in a lot of situations to have a 1031 exchange buyer. All right. Pitfall number 4. We're rolling here. Using a person who is considered disqualified as an intermediary. Yes, you need a qualified intermediary to do a 1031 exchange. No, it cannot be their personal attorney. It cannot be mom. It cannot be you as a realtor. A takeaway here is looking at the QI, qualified intermediary is defined as a non-dis, two negatives, qualified person, right? So we're looking at non-dis, two negatives make a positive, just cracks me up. I'm like, who wrote that? So we're a qualified intermediary, thereby declared under this Rev Proc and the provisions under IRC Section 1031 and Safe Harbor under, it's called G6 restrictions. So we're seeing there at the bottom, that allows us the capability to hold these funds and regulate the exchange agreement. Now, I said, realtor, accountant, investment banker, broker, none of these people or parties can be that third party intermediary. They're already supporting the exchanger taxpayer as a fiduciary or family member in another respect. So within that transaction, we are creating that EA, exchange agreement. We're creating that assignment, as I mentioned earlier, an NOA, notice of assignment. We have detailed closing instructions for title and escrow. And a lot of the time, title and escrow doesn't know how to do a 1031 exchange. Again, this is a federal tax code. We're talking all 50 states. We got west of the Mississippi, we're title and escrow heavy. Some states within right of the Mississippi are title escrow. Majority are attorney states. So some of them that are doing the closing as a real estate attorney maybe haven't seen this as often. So we're coaching them on how the ALTA needs to read in respect to the 1031 exchange language. We're also coaching them on the transfer of funds to make sure there's no taxable event for the exchanger taxpayer. And there are levels of qualified intermediaries. When we're looking at the selection of a QI and who was disqualified, QIs are non-regulated on the federal level. There's no regulation body that is operating over qualified intermediaries, which is absolutely wild. There have been several court cases, even recently, if you Google it, in the state of California of QIs and other states that are not abiding by the timelines and the restrictions and commingling funds. Crazy talk, right? So in looking at who your resource is and how you find the right person, it may be me, it may not be. Whoever it may be, focus on a couple of these as a realtor and a respect client, right? And when they're asking the questions about who you're hiring, who you're referring, non-regulated, but we do have the Federation of Exchange Accommodators. Let's hope that they're backed by that. That's a stamp of approval. Think of this as me getting CE, right? This is just a foreign body that was created saying, hey, we're going to do this to regulate and hold conferences annually where attorneys talk about PLRs, private letter rulings, new court cases, if you will, that indicate a change of something, if anything. The next question I would see is and ask is, are you a member of the FDIC? Are there segregated bank accounts? Where is my client's funds being transferred to? Who's regulating that? So remember, you have different levels, and when we're looking at maybe like a local QI that's just in one state, fantastic. Where are they banking? Then you have title and escrow owned QIs, fantastic. But guess what? They're not a bank. They have to find banks. Where are they banking? Then you have bank owned and operated QIs, which are very few. When we're looking at that, they're always segregated accounts, right? So make sure you ask those tough questions. I want to know where my money's going. I know we all want to know where our clients' money is going for security. I'm going to pause there. Any questions on QIs? Oh, here we go, Rick. Are the QIs able to earn interest during the holding period of our funds? So you have to think in a broad perspective. Why does a QI get into business? Like, what is the point? We're holding money for a living, right? So typically, the QI is pocketing the interest because they'll hold there on average, at least for us, over our first quarter of more than 200 exchanges when we're looking at that. The interest goes, right, within 21 days. You're talking a couple $100. Our bank at Leader 1031, we offer interest out to our clients, of course, anything that's over 3 million cash holding. So we're always willing to negotiate and offer that, especially during a long hold. Of course, everyone wants to make money on it. Now, with that being said, not all QIs offer that. So make sure you ask that question as well. But let's hope that they are able to. Again, that's the livelihood. So if they're able to, then fantastic. Are the funds invested in T-bills? No. So again, when we're looking at this, it's just a segregated interest-bearing transfer account. So it's open and closed within that 21 day on average holding. A lot of the time the holding is in there. I mean, as I mentioned, the simultaneous exchange. Sometimes we don't even touch the funds. So it goes from one escrow to the next if it's within 72 hours of each other. I'm going to address this long question here from Sherry or statement. Let me read through here, guys. Appreciate your patience. What I meant on adding the contingency was to protect the person with the property to be relinquished. They should include verbiage that says the offer they are accepting is contingent upon successful close of the replacement property, blah, 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 with the timelines. That way there becomes an issue. There's no need to sell their investment, of course. So same thing, just said different. Absolutely, right? You can be contingent. That may shy away buyers. Who knows? A lot of the time, if you have that clause in there, as advantageous as it may be for our client, it may push away buyers because they have an opportunity to file it at any time. So that is your wheelhouse. Sherry, you know your clients. Rick, you know yours. Linda, you know yours. I don't have any other names on here because no one else has responded. But sometimes you can feel that out and you want to put that in there. So that's fantastic, right? In some cases, it may not be a good thing. So depending on each different transaction, you have pros and cons for timelines, but I love the emphasis on it. I love the opportunity to add different things to our contract. And that means you're a fantastic realtor because you know the ins and outs of everything for contingencies, not, and working the contract right. All right. Pitfall number 5. Not consulting with a CPA tax advisor before closing on the sale of the relinquished property. This one is crazy talk to me because people don't even discuss this with any counsel and they go ahead and then we get all these questions, which I'm sure you do too. What am I paying in taxes, Kayla? I'm not a tax advisor. I can tell you your basis, your sales price, thereby giving me the gain, right? And the applicable amounts that are applied to it for capital gains taxes. Um, does it make sense? What if they lived in the property for the first 2 years and rented it for the last 3? There's different regulations on that, right? You can use different tax codes and combine them. So we have primary tax code 121. We have investment tax code 1031. Maybe there's an opportunity there. They need to discuss this with their CPA. And sometimes they don't reveal all their cards to us, right? We're helping them, supporting them, but in some cases, this may pop up later. So make sure that they have that discussion. We can look at that value of replacement that we talked about, what we're buying, the buying power, so we get ahead of the exchange, which goes all the way back to the timeline and knowing what our purchase price power is. This is a great chat with the CPA. I can't tell you how many times I've told someone to not do a 1031 exchange in my life. When they have a small amount of gain, let's say they bought for $1 million and they're selling for 1.5, 1.15. So 150K gain. Now we're talking all the closing costs. Let's say you're around, I don't know, 75,000 in closing costs. All right. So now your gain is only 75 that you're pocketing. What if they have losses that the CPA can declare for them? What if they have an adjusted cost basis? They improve their property, thereby shrinking the gain. There are so many questions here that the CPA is in charge of to discuss with them and just see if this makes sense. But again, I'm like, if someone tells me they've gained a 50 grand and they have really low closing costs and they want to buy more real estate, fantastic. If they don't really have that much gain and they don't really want to buy more real estate, don't exchange. Doesn't make sense, right? Don't pay our fee. Don't go through the timeline restriction. Pocket it and move on. Any questions there? The last one was kind of a short one, but no. Okay. So this is that entity one, not handling partnerships or LLCs correctly. I'll say a quick experience first. One of my most recent ones, because this is not the only one. I had an exchanger come to me saying, hey, we're selling our property. I need to set up an exchange. Perfect. We pull the contract from title and escrow, coordinate with the realtor, make sure we have the prelim on hand or a current deed. The deed or the prelim will then reflect an LLC on title. I then have to ask the exchanger, the entity on title is not what you said. It was an individual that we discussed. Oh, well, actually, it's my mom, my uncle, all of these other parties, right? And only one of them wants to exchange. So in that scenario, we have two options, a drop and swap or a swap and drop. What this looks like is we're gonna drop the LLC. So we're gonna quit claim deed title and we're gonna go tenants in common. Everyone's at 20%. Say there's 5 people on title and there was 5 in that partnership. We would need to do that. Now, if you change title, your intent to hold goes back to the year and a day. There's a new entity on title. You have to hold it, you drop title, then wait a year and a day, then swap. This slows down your entire transaction and the offer and the whole purpose to begin with. If the LLC wants to do as a whole a 1031 exchange and do a swap, then drop, they would exchange now, call it by 5 different properties, all with the LLC on title, wait a year and a day, then quit claim those into their individual names. That's more advantageous, but again, all of those parties have to be willing to participate. It's a little unique when we experience this. In my recent one, it was 5 family members, and now we're back to the drawing board where they're relisting, and that this was about 3 months ago now. They quit claimed. So now they're tenants in common. I will say if you're ever discussing this with your clients and they're asking or saying, I want to be a partnership with so-and-so and so-and-so, that may be advantageous, or everyone has their own LLC and your tenants in common in your individual LLCs for protection. Having your undivided interest on title is a benefit in investment world because you can go your own way when it sells. That's your undivided interest. That's your exchange valuation of your percentage. All right. And so when we're looking at the exchange and drawing our documents, who is the actual taxpayer that's selling? If someone tells me, hey, Kayla Franklin, my maiden name, I bought a condo in Oceanside, for example. Then I wanted to exchange it as an individual later in life. I could, but I'm married for 7 years now, and maybe I want my husband or our trust on title. Midstream, if I change it from my social security number to now his, because we're married filing joint over here, that may raise a red flag with the IRS. So the entities that can be switched out are going to be an individual. So let's say that it's husband and wife, Trevor and Kayla, my husband and I, as individual taxpayers married filing joint. And now on our replacement property, we want to put it in our trust. It's the same taxpayer ID. It's his social security number applied to both, right? If I say, you know what, we're in a community property estate, we want to do the sale in our individual names and then buy it in a sole member LLC, that works too because it's a pass-through entity, sole member disregarded to our Social Security. A huge issue comes up if we're looking at maybe converting it towards our husband and wife into a corporation or that LLC that's regarded, adding more parties. So that's a huge red flag. And if you see this in a transaction, all of these parties or members in an LLC, ask those questions. Does the whole LLC want to do an exchange? How do you want to buy? This may affect their financing, right? Different states need different qualifications for different, new entities they want to create that go on title. So being upfront with your clients, understanding who's actually signing your listing agreement, pull that title, talk to your title reps, understand that you don't have to go back and then amend the whole contract halfway through because it's in fact a different seller. Then it does this domino effect with escrow docs, disclosures, you got everything from our job, you got transfers, lending. So getting ahead of it with that entity on title is crucial. I'm gonna do a quick pause here. Excuse me. That's why I love these in person or like live. And I know Elsie's probably half and half watching here, but I always love the interaction. So if anyone has a question, fire away, please, because I feel like I'm just talking to myself. All right. Pitfall number 7 is not evaluating the entire exchange transaction on both sides of the exchange. We briefly talked about the value of what you need for full tax deferral, right? If you don't look for replacement property early enough in the transaction, you're almost destined for a failed exchange, right? Called a blown exchange. To Sherry's point that she wrote there, right? Having contingencies, understanding the timeline, being aware, maybe on the sell side, but also for me is working the longer close on the sale, longer close of escrow with an opportunity to shorten it up. On the replacement side, getting ahead of that, making all those offers, secure all the properties, right? Again, they're just handshakes. The final identification is the critical point. Um, yeah, we know, in this data here, many well-priced properties are selling within a matter of days. Yeah, the market's not as intense as it was. In different markets, it is. So again, I'm all 50 states. Our headquarters are out of New England. I'm California, of course. So when we look at different pockets of markets, they're hot, right? People want to sell out of different states, exchange into other states. So getting ahead of it, I have a client right now who's selling out of Seattle, several of them, and they're selling out of Seattle, they're buying in Florida. Weird, right? Like so many people are buying in Florida. So they were already boots on the ground in Florida as soon as their property was under contract in Seattle. They're like, we're not even going to wait. We're just going to start making offers. So the relinquished property closed this last week and the replacement is closing this Friday. So getting ahead of it, right? Now, closing costs we discussed. I want to be open with you here in talking about what you can apply these proceeds to. You can't buy down points with exchange proceeds. You cannot pay for repairs. So if there's a credit, right, that's a taxable consequence. That's boot going towards the buyer. So if you're repping a seller and there's credits asked, maybe do a reduction in price. Hopefully that works. If they need to do a credit, fine. Anything over $1,500 boot, which I know, repairs are mostly going to be over that. They're going to pay taxes on just that portion. That's a credit. What you can apply the expenses to on both sides of this equation are the broker commissions, so real estate agent, professional fees, exchange fees, transfer taxes, escrow recording, attorney fees, title insurance fees of the owner's title insurance policy, and anything that's just your general fee, right? This miscellaneous like printing fee, all that, or service fee, what have you, that we see on settlement statements. All of that is typically included in the exchange expenses. No on the inspection. Believe it or not, you cannot use exchange proceeds for an inspection on a replacement property. I find that pretty wild because I'd want to use those funds to investigate, but it's not going towards the real property. It's going towards a service of investigation. Any questions on closing costs while we're here? All right. The capital gains, what's applied to that credit or maybe the boot that I touch? Number one, components. There's 4 components of capital gains taxation applied to our gain, right? So let's say I have $1 million that I'm taking in boot. I'm doing a traditional sale. I'm not doing an exchange. And I have $1 million in gain. So this is going to start with depreciation recapture tax at 25%. I love depreciating properties, but if I'm going to do a traditional sale, guess what? The IRS wants to get paid back. That amount is 25% of what I've paid or what I've written off for depreciation. So I had 100 grand, let's say, that I depreciated. That's $25,000. Now I'm going to pay my net investment income tax. This is healthcare, Obamacare tax, 3.8%. So I'm now applying 3.8% to my million gain. My federal capital gains taxes. Depends on my income bracket. I could be 15% or I could be 20%. 20%, think of high 400s, married filing joint, right? Or greater. So we're majority, let's go with 20%. So now we're at 23.8% and that fraction of my depreciation recapture. Then I have my applicable state tax. Does anyone know what California's applicable state tax is for capital gains? We have some states that are 0, and then the highest in the country is 13.3. Does anyone know where California lands there? That's right, Rick. 13.3. So now we're doing the calculation and let's backtrack, right? 13.3, and that's low. Then we have millionaire tax and we have all these other things that are adding into it. So we're at 13.3 plus the 20, we're at 33.3% right there. Then we have the 3.8, right? We're at 37, 38, depreciation recapture. Now we're at call around 40% rounding out, depending on how much that person depreciated. So let's say I'm at 40%. I'm doing a traditional sale and I'm paying $400,000 to the government after holding my investment property and only getting a net, back of my gain of 600 grand after I pay taxes. 400 grand is an entirely new property or a down payment for one, especially in other states, right? So there's an opportunity here for even someone to do a partial exchange. It's a big takeaway here when you're talking to an investor that maybe they don't want to sell. Maybe because of these reasons. Well, guess what? They can exchange into something else that's like kind, something different. This is a big one for us, in our Mission Beach, Pacific Beach, San Juan, we're looking at Laguna, San Clemente, all of these areas from, Orange County south when we're looking at fourplexes. I always get tied up because East Coast, when I do these on the East Coast, they call them four family. It's not funny. A four family, a two family, three family. So we'll go with fourplexes. Say they live in one and they rent out the other three. We call this a split treatment because someone's going to buy the whole building, right? The fourplex. This is so unique. They get the advantage of Internal Revenue Code, and that's that little dollar squiggly ampersand looking thing. That's IRC section. It's just an IRC. So like, what's the number of the tax code? That one's 121. 121 is your primary exemption, right? Single filers get 250K exclusion on gain. Married filers get up to 500K on just the primary. The rest, I have investment that I have appreciation on. I can exchange those. How would that look, right? Let's just use round numbers and say it's $4 million. Selling it for $4 million. The one that I lived in, I get the full exemption of 500K. The rest I'm exchanging out. Well, we would go all the way back and talk about what the basis was, what I purchased the property for. The square footage of each property, say they're all identical. We can do it price per square foot and break it down that way, the exemption. And of course, you know who I'm calling during this transaction? The CPA, to have them break it down with the purchase price, the basis, so that we can have that ALTA distribution, the settlement statement indicating that the cash due to seller is actually going to seller. The remaining cash is going to leader 1031, qualified intermediary on behalf of Mr. Smith, right? So you can split the treatment here. So neat. I love this one. Same concept applies. I don't know if I have it in here. Nope. The same concept applies. I'm in my home office right now. I write this off. You guys write your office off. Let's hope that you are documenting it. If you have ample gain and you've been writing off your investment, your business or productive use section, and you have ample gain on your property, price per square foot, right? You can now do a split treatment exchange with this one portion being split off for your investment and the rest as your primary. So here's another creative like-kind replacement is going to be going over Rev Proc 2008-16. Now, just pulling back the layers here, a revenue procedure or Rev Proc, the figures you'll see are 2008 is the year it was created and it was the 16th one that year. So that's why the number, it's nothing fancy. And this one, this is just vacation rentals, right? So think vacation, 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 2008. Now, following this, I like to call it the 222 rule. All right. What you do is 1031 exchange your relinquished property into a replacement property. You have to hold the replacement property for at least 2 full calendar years. You then have to rent it out to a third party, could be a family member, for a minimum of 2 weeks each individual year. Then you can stay there for 2 weeks each individual year. Or you can rent it out for, let's say, 200 days, right? If you rent it out for 200 days, then you can stay there for up to 10% of the time, 20 days. If you are there to paint the property, to have upkeep, there's oxidization, we're close to the beach, there's wear and tear, right? We need to repaint it. There's, I don't know, something that needs to be fixed in a wall, a toilet, whatever it is, and you're staying there. Document that. Keep your receipts, right? This is your property. It's an investment. You're there for business purposes. That doesn't count towards this timeline. This is fun use, right? So this is very advantageous for people who eventually want to claim this as a second home because after the 2-year marker, not only have they kept up with this upkeep of the property, they've rented it out and reported on their Schedule E, their rental income. So paying some taxes on that and then getting some personal use too, right? So this is very neat for someone who maybe thinks, I just am going to do the long term. I'm just going to hold this investment property. Well, what are your dreams, Mr. Smith? Where do you want to buy? Right? Maybe they have this dream of going to, I don't know, McCall in Idaho, Lake Payette Lake. A lot of San Diegans have bought up there. And same with everyone. Actually, I think I met people recently from Orange County that have purchased there as well. So it's a big hub for skiing. Maybe their dream is there. Maybe their dream is skiing in Vermont and they get this property to stay in, right? So keep this in mind that Rev Proc, there's an opportunity for personal use as well. There's that last one that I discussed already. Questions here on the Rev Proc? Pretty common one, especially for coastal properties and short-term Airbnbs. All right, I'm going to roll into the DST and then open for questions here before we go into the next one. So this is really focusing the RevProc 2008-16, right? That's looking at an opportunity for your investor to find something different, something unique from a long-term tenant. The DST is back to Sherry's point, and I think maybe Linda asked it, actually, my apologies, about do we have an extension, right? You can identify what's called a Delaware Statutory Trust. A DST is both a security and real estate. So imagine, let's say a high-rise building in Newport Beach, right? Commercial office space. And that building was purchased by someone called a sponsor. Sponsor's just an investor, right? So they bought this land, they built the building, and now they're going to offer it for sale, fractional investments to accredited investors. So that building is going for, let's just go high and say it's valued at $100 million. I don't have $100 million. I wouldn't be doing this if I did. But let's say we all are contributing, that Rick is doing an exchange and Rick has 3 million, sold for 3 million. His timeline is almost up in the 1031 exchange. And he says, hey, Kayla, as my accommodator, do you have any suggestions? I don't want to pay taxes on this. I need a safety net. Hey, Rick, I'm going to introduce you to a registered representative. Think of a registered rep as a salesperson, a real estate salesperson, but they have their securities license. So they're the only people who are gatekeeping these, right? And have the opportunity to, I guess, if you will, present them to accredited investors for sale. So they're only accredited investors buying this offering. So Rick says, okay, I love this. I'm going to identify this property as the DST through Inland Securities. That's one of the sponsors. And it's going to be an Amazon industrial warehouse. And he's buying 3 million at a percentage of blah, blah, blah. Okay. Then Linda says, all right, I also want to exchange into this. I've been actually looking at DSTs because I don't want my long-term investment property. DSTs also offer me mailbox money. I'm not managing the tenants anymore, and I want to sit back and retire. I want to go out to Florida, and I want to relax on the beach, right? Totally fine. So Linda buys in with her $1 million. She has a portion of that. And then Sherry decides, you know what? I've got a $5 million building. I want to exchange into it as well. She buys her portion. That means every month, based on occupancy in this building, they're each going to get a different valuation of check and return for that occupation, right? The tenant's paying to lease that building. DSTs, both security and real estate. That's your safety net. I love DSTs too, Sherry. Our family's invested in a few. And a couple takeaways here. It's an opportunity for diversification. If you think back to that equation that I showed you, that was the $900,000 sale of Mr. Smith and he bought for 700, maybe that 140K can go here, right? So now you're coming in as a hero saying, "Wait, Mr. Smith, you bought this property. I know you don't want to pay taxes and you really wanted that property, but it wasn't high enough for your valuation. Let's talk about DSTs, or let me introduce you to someone, right? That can talk to you about DSTs." So, pros and cons here. They're highly illiquid. Illiquid. So if you have an investor that's gung-ho on management, that wants to rip down walls, move assets every 2 years, this is not for them. A DST is a longer hold. They typically go full cycle is what they call it, meaning they're ready to sell when a buyer comes in, and they don't really list the property for sale unless they have appreciation or, heaven forbid, it's a loss, which is very, very rare on these. So they typically go full cycle between about like 5 to 7 years. In the last 3 to 4 years, I've been seeing them go full cycle between 2 to 4. So a little bit more advantageous, call it that sweet spot of 3 years. But if someone wants their cash, say something happens in my life, I'm an investor here and I need my cash now. The only way I can get it out of my DST, I'm in the investment, let's say the same DST as Sherry, Rick, and Linda, and I decide, wait, I need my money. I need to get out of here. There's health issues in my family. I can only sell to the three of them or any of the accredited investors, and they're smart. Maybe that property has appreciated, but they know that they're the only buyers able to buy this. It may be a hot ticket and it goes for more, highly unlikely. They may lowball and say, you know what, you're limited, so we'll buy you out. We'll take your shares, right? Not shares, but your undivided interest, right? Or your portion. So we can take that from you. It's the only way you can get out of it early, right? Now, when this DST sells, it goes full cycle. Guess what you're doing again? Exchanging. So those sale proceeds go back from the DST sponsor. We coordinate with title and escrow. It's a big sale of this $100 million building. The cash goes into a segregated bank account that we hold on their behalf as later 1031, and then transfer funds out. Maybe Sherry's representing them as a buyer's agent now, and they're ready and they know the property they want to buy, and it's perfect timing. Now they can go back into traditional real estate. Maybe they hold that replacement property for 2 years, then they move into it as a primary. So now they've made money in all these series of exchanges and investments and finalized their game plan of retirement. Wait 2 years of holding an investment or an exchange property, then you can claim it as a primary. So DSTs are a really neat safety net and highly, highly desirable, especially in our baby boomer generation of just, hey, I just want the mailbox money. Let's let this ride. I'm going to pause there. So that was DST overload. But I just want you guys to be prepared that there are alternatives, vacation rentals, the split treatment option, the land opportunity, DSTs. There's so much out there. And while we want to believe that we can double end the deal, maybe rep a client who's selling for 5 million and then buy them 5 different replacement properties, all for $1 million each, that'd be great, right? Sometimes that's not always the case. Let's unlock that listing, get you that guaranteed for sure, then lean on that client and have them lean on you as the exchange agent to look forward as opportunities. Maybe they buy one property for 3 million and diversify between the other options. Hi, Linda, I see your question. After completing a 1031 exchange, owners should wait how many years? Look at that. I beat you to it. Didn't even see it. So she's asking how long to convert the property into a primary. It's 2 full calendar years, right? So if I close today, I need to wait until 2028, June 24th. And again, when we look at converting, it's just claiming it. We file our taxes. Did anything change this year, right? Whether you're doing it with your CPA like I do, or you're doing it yourself on TurboTax or what have you, whatever the programs are. If anything changed, yeah, I moved into my primary on this date, right? So it's documented. So I'm just claiming it now where I get the benefits of home ownership. Different states, different homesteads, write-offs, so on and so forth. All right, we're rolling into our last 2 pitfalls here. I've been going fast, which is good. I hope it's not overflow with you guys. I feel like the questions are on point, so you guys are dialed. All right, pitfall number 8, engaging in related party transactions. Huge no-no. So personal experience, that condo in Oceanside. All right. I was in my early 20s. I was crushing real estate. I didn't have enough to buy the condo. So my parents bought a condo in Oceanside that I paid rent, right? Living there. My plan was to wait 2 years so I could stack more cash and buy it out from them. I was about 25 years old and I said, "Hey, let's do this. I'm ready to go. I stacked enough cash. I've got a loan." They said, "Absolutely. We bought it so that you could buy us out. We knew it was a great deal and we wanted to get this property." So I go to buy them out and I come to discover that my parents can't take the cash in the sale. They have to exchange out of this property because in 1031 or investment world, for this to work, no one can end up with cash. I couldn't exchange into it. I couldn't buy it. It's their investment. I mean, sure, they can pay a huge hit, but for the 1031 world, I cannot exchange into it while they cannot exchange and end up with cash and then gift it back to me as inheritance. Does that make sense? So we're looking at related parties, the reason why, hey, I'm buying this primary from someone else, but I'm exchanging into their primary, and mom ends up with cash, but their exchange funds going in. Mom can gift you that, or mom can send it to you for inheritance if anything happens to mom, right? So in a related party transaction, no related party, brother, sister, mother, son, daughter, father, right, whoever, uncle, can end up with cash in the 1031 exchange format. I cannot use exchange funds into, they need to exchange out of. There can be no cash in the situation. Related party transactions. So I couldn't sell an investment property and buy into that condo to use it as a portion to move forward. So when we look at that, and we have a lot of these legacy properties, people who have held real estate for years in Orange County, years and years and years, and they don't want to sell them ever. Balboa, hello, right? So when we're looking at these areas, knowing this restriction, who are you actually selling it to? Let's be careful on who's collecting the cash and making sure that no one ends up with it in these transactions. Questions on related party before I go into the last one in questions? Pause for a sec. All right. All right, not understanding reverse exchange or parking arrangements is what we call them. Now, why do we call them parking arrangements? When we park a property, the only thing we're doing that's different is changing title. So if I create a brand new LLC right now and I put it on title to a replacement, I'm essentially parking it, or it's sitting here waiting for a transaction. We talked about entities. So in the 1031 world, Kayla needs to sell, Kayla needs to buy. If there's an LLC that already acquired this, I can buy it from the LLC. That's kind of the basics of it. Now, a reverse exchange means the exchanger taxpayer is acquiring that replacement property first. Okay, so they need to have enough cash or a combination of cash and debt, right? A loan to outright purchase this property. Why? Well, there's no cash from the sale yet. The relinquished property hasn't closed, right? So now we're doing the reverse. Let's say this person has enough cash. They have $1 million cash. They go out and they set up a reverse exchange. Takes about 2 weeks to set up. So make an offer. Then they connect with their qualified intermediary. And in-house, we have what's called an exchange accommodation title holder, EAT, EAT, right? So the EAT has shelved LLCs. It talks to the exchanger and they say, hey, you know what? We'll set this up for you. This 123 Main Street LLC will be parked on your property. So they close escrow in 30 days. 123 Main Street LLC owns the property that they fronted the cash for. Close of escrow starts a timeline of 180 days that they have to sell the relinquished property. So now they've secured the replacement already. Now they just have to sell this one. Sounds easy enough. Let's say it's successful. The relinquished property sells, then the cash goes through escrow, right? Transferring from escrow. Then it goes to the qualified intermediary, leader 1031, and is dispersed back out to the exchanger to pay off the loan. So in this format, it's highly desirable for someone who sees a crazy market or something that's available and they're not ready to list yet, or it's not listed yet. So they can jump on it and acquire that replacement property first. Now, if we backtrack, and we say, hey, wait, I couldn't sell my relinquished property within the 180 days. That's awful, right? In that scenario, what would happen is they own both properties, one owned by an LLC that they could take assignment to and say, we're just going to keep the LLC on title. They could quit claim it to whatever they want, more fees, right? However, the relinquished property, they still have an opportunity to do an exchange, but they cannot exchange it into this property. It's not part of that transaction anymore. The timeline is expired. They have a blown reverse exchange. So they can buy a separate property, but now they're the proud owner of both properties. Positives on that one, right? Their basis is whatever they bought it for. It's removed from the exchange capacity. So pros and cons there. It's advantageous to get ahead of it. Again, back to Sherry's point, contingencies are critical. Let's hope you guys can sell a property in 6 months because I believe you can. So hopefully the reverse exchange works. They are common, excuse me. A lot of the time we would see them for brick and mortar if someone's expanding a business, right? And they needed a commercial building, they can acquire it ahead of time. And then in a lot of cases, maybe there's that one property that popped up in the neighborhood that they wanted and they need to jump on it. So it works there too. An improvement exchange is when you take excess cash and use it towards improvements. So example, I'm selling for $1 million and I'm buying for $750. I'm now connecting with the EAT again. We've done the delayed exchange where the cash went from the sale to the segregated account. I found the replacement, I identified it, and I'm talking to the EAT to say, hey, I'm going to do an improvement exchange because this property needs love, okay? So I'm going to close on the replacement property with that EAT title. 123 Main Street is parked on title. Now I can draw on my remaining $250 that's sitting in that exchange account as an individual and improve that property. Needs a new roof, needs a whole new driveway, needs other foundational things. It needs electric, it needs a wall broken down, a new island, whatever it may be. I can use those sale proceeds to improve that property so that the valuation maybe equates my relinquished $1 million for $1 million. Pros and cons here. I have to use all of those funds within the 180-day timeline that starts when my relinquish closes. So if you need a permit, that's going to take a while, right? If it's general contracting stuff that we can work with and a GC writes up to unambiguously describe those improvements, we add it to the identification form. They need to be used towards paying the GC for real property, cannot go towards personal property. Say you're prepping an Airbnb and you want a funky, cute neon green couch and leopard print, whatever, for a photo wall to promote it, right? Nothing goes towards that. It cannot be used towards FF&E, furniture, fixtures, and equipment, specifically towards real property or capital improvements to the real estate. Let's say that there's excess cash in that account and there's 100 grand left and you've used as much as you can and it's day 180. Completely fine. You did what you could. The remaining 100 grand goes back to you on day 181 and you're paying taxes on what remains as that 100 grand cash boot. So improvements are pretty fun. I mean, I want to use one in my future. I think it would be advantageous, but getting ahead of it, what are we buying? Excuse me, in order to secure these replacement properties, while using the delayed exchange timeline, delayed because timeline and we're delaying recognition of gain where the money moves forward, you can always write an offer, put a huge earnest money deposit with a long close, right? To secure it. So those are your contingencies again. A built to suit exchange is built from the ground up. So same scenario that I talked about with the improvement. However, maybe I'm going to go ahead and say, it's just land and I want to improve it. If I can't spend all that cash, but I spend as much as I could, same concept applies. I'm paying taxes on what remains, but I now need permits. I need everything permit up to code, everything that's going into this property. Maybe I only have enough money to pay for pouring the foundation on my land and putting up sticks and some electrical. Completely fine. Your timeline is still 180. So in California, built to suit is not done very frequently just due to our regulations on permits, especially with coastal commissions, so on and so forth. The improvement exchange is used a little bit more frequently just because of, the sequence of timelines, you can get some improvements done. All right, I'm going to stop there for a sec before we wrap up. I think I went pretty quick, which is good. So, does anyone have questions on the improvements or a reverse, maybe something creative they've experienced? A client asking them to do something with funds that there was an issue. I'll pause for a sec. All right. If they come in, I will keep my eye on it, I promise. So I mentioned this term a few times, exchange agent, right? Everyone has a whip on their forehead. What's in it for me? I mean, I do every day that I wake up. What is in it for me today? What am I doing? Am I hitting the gym at 5 a.m.? Am I gonna have a wine night with the girls? Whatever it is, right? So when we're looking at our lives and our clients' lives and your focus to become an exchange agent, we're focusing on farming investors specifically. And what's in it for me? The return, of course. You're not only saving your clients potentially millions of dollars, but in most cases, hundreds of thousands of dollars. You're helping them redeploy their investment through the 1031 and potentially landing duplicate listings. We talked about the advantage of maybe being the listing agent and the buyer's agent. So numerically speaking, let's say you farm 100 investors. I'm okay at math given my career. But let's say there's an average sale of every 5 years per NAR, right? Investors sell every 5 years. That's 20 sales, right? 20%. So 20 sales every year. That's 20 relinquished property listings that you could potentially get every year with the opportunity of being their exchange agent, buyer's agent on the replacement. Now we're doubling our sales numbers at 40 a year. Again, it's not always an opportunity to buy a replacement, especially if they're going in a different state. Work on all of that with commission for other agents, right? To discuss that in other states. How can I get paid on that? How can we support? So on and so forth. But numbers don't lie in this scenario. If you start farming these investors, the numbers will speak leaps and bounds for you, especially in your bank account. Again, I started doing real estate in my early 20s and I started working with so many investors. I was then recruited by a qualified intermediary to go work for them. I learned so much and started crushing it using this formula. It does work, I promise you. So if you ever need support on how to farm these people, how to, send out, different mailers, we have a ton of these items for you to win the deal. And then I recommend always connecting with your title and escrow team, right? They always have like the non-owner occupied apps and things like that. So use your resources at OCAR. And a quick takeaway for our highlights here as we wrap up is consult an experienced QI, right? Talk to that QI. Does this make sense? Run through it first before maybe you pitch it if you're feeling a little anxious about it. I always say I'm on your team. If you want to do a consult call, hey, I have a QI that I work with, they're on my team. I'm gonna ping Kayla in. I'm gonna text Kayla, whatever it may be. We can do the consult together, but let's make sure the consult's done. Sometimes I will say, hey, this is a slam dunk. Great work, Rick, right? Whatever it may be, and it's ready to roll 1031 exchange. Always consult with that tax advisor. Number two, ensure that the sale contract is assignable, right? That cooperation clause. That's our job as a QI to create that letter of assignment, notice of assignment for the buyer to sign it when the seller's doing an exchange. The exchange cooperation clause establishes the intent to perform the 1031. It releases the buyer from liabilities and notifies the buyer in writing of the assignment to the QI. Because what we're doing in the exchange is we're assigning the rights become the seller, but as the seller to the leader 1031, the QI from the seller. So individual name transfers to the qualified intermediary at reporting. There go the funds, so on and so forth. For full tax deferral, they must reinvest their net exchange proceeds and acquire a property with the same or greater debt. If there's anything you take away today for your valuation proposal for your clients, you know what they're buying. Net plus debt, right? The taxpayer must identify the replacement property to be acquired in accordance with the rules of ID within 45 calendar days, right? So no extensions, unambiguously describe the property. If there's improvements, what are the improvements and what is their value? And the taxpayer must close on the replacement property by the 180th calendar day or their tax filing date, whichever is earlier. from the close of the relinquished. All right, that will wrap it up for me. I will pause for a sec. If anyone has questions, please fire away. My cell phone is listed on there too, and my direct email. If you need any additional content, flyers, whatever I can provide, resources for education, please don't be shy. Give me a call, and I appreciate your time today, all of you, for reinvesting in yourself with education. I hope this is a win for you, and you get to work with some investors soon. So. Thank you all so much. Have a great 4th of July coming up. Appreciate all of the questions sincerely. All right. Thank you, Elsie. Appreciate you. Oh, we have a question. Pause. In surveying QIs, I've gravitated towards accruity and asset preservation due to their size, transaction volume, and interstate service area. Are there any benefits to using a local QI that might be smaller? So, I love Accruit. I'm very close with the sales director, great guy. And I worked for API for 5 years. So they are great companies. There's nothing wrong with those companies. They're fantastic. Um, Again, they're title-owned QIs. Accruit is its own beast. It's more in software and generating different things for Qualia right now, focusing on, having this support. So Accruit's goal is to support other QIs while operating as a QI. They're fantastic at what they do. They're software techie brain. API is backed by Stewart Title. They're an in-house qualified intermediary where they get referral handouts from Stewart Title and escrow, right? Keep in mind when you're working with them, where are they banking? At any given time, they could be working with different banks. So it's always important to ask your representative at API, hey, where's my client banking? Where their funds going to be and who are you guys banking with right now? I know, Rick, you asked that question about rates. Ask them about rates. Finding a benefit of using a local QI. That's a tough term. A local QI, I mean, you could say where they live is local, right? But I mean, Accruit, API, they're national. We're a national qualified intermediary. I'm local, if you will, but I work for a national QI. So if there's a mom and pop QI, there's nothing wrong with that. I would make sure you establish rapport with them, build rapport, right? Make sure that you're comfortable with them. How is their pitch? How's their pitch going to be with you and a banter with your client? Do they make your client feel secure? These are all important things because you're the quarterback in your deal, right? You have an O line full of all of your affiliates, your lender, your title, your escrow, your QI, right? You got your appraiser, you got your inspectors. I mean, you can't really designate the appraiser, but you got your inspectors, your team, right? All of these parties. So making sure that you know when there's a handoff to be made, that you can trust your O line. I think that's the most important thing, but everyone has their strengths in their industry, right? So just ask the tough questions. I don't think there's anything that's better or worse with either one. It's who you trust. Okay, thank you for the question, Rick. I love that you use those two as well, because I love both of those companies. I think they're great as well. All right. Okay, well, I'm going to sign off. Thank you all. Again, Elsie wrote in there that this was recorded. If you need to go back and pause, it might have been quick, so you can pause and go back again and again and again. I'm also a live resource, so anything you need, you now have my cell phone and my email. It's also on that handout. One more from Rick. No problem, Rick. Last question. Have you experienced any pitfalls that were not mentioned when doing an interstate exchange from condo to a co-op interest? Well, not necessarily co-op, maybe TIC, it could be a reference. I mean, I don't really have any issues from state to state. I'm versed on withholdings in all 50 states as a QI doing this for a decade, right? So I haven't had any issues. I think the main pitfall is getting ahead of it, which goes back to timeline, making sure that the client knows what they want to purchase. I mean, if they're living in Newport Beach and they want to buy something in, I don't know, say Nashville, and they've never been to Nashville, they should probably get out there, right? And start partnering with someone, hopefully, that you can refer and get a referral fee. I would say being aware if they're going into a closing attorney state that they will need a real estate attorney and that the seller will have a real estate attorney and then there will be a title company. There's a lot of different fees associated in different states. that's kind of it. I think is just getting ahead of if they are going interstate, where are we talking? What are we dealing with and what do we need to unpack here per that state? Amazing. Okay. Well, thank you again. I appreciate you all so much. Yes, you're so welcome, Rick. I appreciate it. Save my number. I'd love to continue a conversation with you. I clearly geek out on this and you do too, so I love it. All right, Elsie, thank you so much. You guys have a wonderful 4th of July.